All right, we're moving into our final segment of the survey this afternoon. And I just want to remind everybody at home, there are 2 CPD hours allocated for this session. If you stay till the end, you'll get the QR code so that you can download the 43, 44 page report in its entirety. You'll be the first people on the planet to get it. We'll also be announcing the winner of that UPS system, just in case load shedding does return to us again, which it probably will as the temperature starts dropping toward winter. Yes, certainly last but not least, I'm joined by Tebogo Leshilo and Mwenda Dejenga. I work with both of them in the financial space. Yeah, welcome Tebogo, and welcome Mwenda.
Thanks, Simon.
Thank you very much, Simon.
So, sure. I think we're going to be sort of working through some of the numbers in the financial line space now, and then I think we'll split into a little bit more detail in the DNO and cyberspace specifically. So financial lines. People who are watching Garrett's segment at the beginning would have seen that the line of business is quite volatile. You know, it goes from running quite well to suddenly having a spike, and of course we had that lovely 500 million rand claim that had to be paid at the beginning of 2020. So there is an element of volatility here. Tebogo, I don't know if you want to comment on that at all. Certainly when it comes to pricing, we have a lot of brokers, certainly in the meetings I've been in, going, but I haven't had a claim. Why is my premium going up like this? Can you just talk to that?
Thanks, Simon. I think what we do need to take into consideration in the financial line space is looking at the nature of the business that we underwrite, with it being financial institutions typically, as well as a lot of the listed entities. I think we're prone to a lot more severity type losses. So while we may not see as much frequency as you would in the other business units that we have here at SHA, looking at the line size that we put down, as well as factors such as the increase in regulatory changes, as well as the climate in the country, together with the types of business that we write, looking at a few years ago, we would have had a considerably larger commercial crime book than we have now. These are the factors that would certainly contribute to how we perform from a claims basis. I think that the one change that we have seen and is also evidenced in our loss ratio looks at some of the improvements and the changes that we've implemented in our underwriting standards as we've gone along in response to, I think, both the experience in the local and global insurance market hardening, as well as a response from our end in order to manage our loss ratios.
Sure, thanks. Mwenda, yes, please.
Yeah, I think it's also just very important to bear in mind long tail nature of these claims. So they do, like they do in the PI area as well as the liability area, do take a couple of years to mature.
Yeah, we know this all too well. I think that 2013 years proved to be quite infamous. Brokers can have a look at that when they get the report at the end, just to see where those spikes sort of came into the portfolio. Can we move on to the next slide, please? I'm going to focus on DNO for a second. So Tebogo, the next couple of slides, but I'm going to be focusing on you. Although Mwenda, please feel free to jump in. You don't have to wait until we get to the cyber segment. When we chatted to our brokers, Tebo, 14% of the respondents said that they'd actually noticed an increase in claims notifications, which kind of seems to be in line with what we're seeing at SHA. Is DNO big business issue here, or is it something that we're kind of seeing across the board? D&O claims activity?
I wouldn't say that D&O is simply a big business issue, especially where claims are concerned. I think even with looking at your smaller private companies and enterprises, there are multiple sources of claims that we need to take into consideration. It wouldn't just be the large entities who are looking at their public shareholders, perhaps bringing claims against them. So we are seeing an increase. I think this is also driven by an increase in consumer awareness as well as competitor activity. So it wouldn't just be your small entities. It wouldn't just be your large entities, sorry.
It's kind of across the board. I saw something in the report about an increase in companies actually bringing actions against their directors. Any idea why that would be? And has anything happened in the last year that could be influencing that?
Well, I think what we would see is greater calls for accountability on the part of directors. We have recently seen the ACA judgments relating to two large entities where the directors, where the shareholders of these companies brought claims against the directors. Unfortunately, these claims were dismissed by the Supreme Court of Appeal on account of the fact that it ought to have been the company who brought the claim against the directors and not the shareholders. The duty of the directors is owed to the company and not the shareholders. However, I think what we do need to take into consideration, especially from the importance of purchasing D&O cover in this regard, is looking at the legal defense costs that could be incurred in the event of allegations against directors, as well as the policy's response and supporting directors to respond to these.
Yeah, it's a good point. I mean, just to the other side of the slide there, and this is not something unique to financial lines, but we measured a 56% increase in legal fees since 2016. And I think I saw one of the remarks in the report, inflation over that period of time, year on year, was about 5.5%. So that kind of way outstrips that. And so if I understand what you're saying correctly, the directors should really be looking at this as at least they've got access to proper legal defense, rather than just kind of throwing their hands up in the air and saying, well, I can't defend myself, or not buying the cover because they think it'll happen to them.
No, absolutely, Simon. I think we need to take into consideration the fact that the long tail nature of D&O matters and other financial lines related matters is that these often drag on for a very long time. Looking at the complexity of some of these matters, the involvement of other parties such as regulators, you could see these high requirements for documents, lots of scrutiny from third parties, and these complex matters take a lot of work. We look at bringing in very specialized counsel. We need to take their costs into account as well. So it's not necessarily just looking at settlements in D&O matters, but the way in which claims pay out and how a company would protect their balance sheet as they sustain any type of defense.
Okay, thank you. Can we move on to the next slide? So risk management formed a significant part of this year's report, in fact, across all the lines of business. But when it came to corporate governance and to the audience, you'll see when we talk about the cyber environment, obviously risk management is critical, which I'll be discussing with Mwenda. But on the D&O side, I think business owners often don't think about risk management, or at least executives. So less than 50% of the respondents asked directors to sign any kind of conflict of interest documents. Less than 46% do criminal background checks. and under 20% actually said that they do lifestyle audits on key members of and the board. What do you make of this? How important is this in your environment in the D&O space?
I think where this plays a big part is that you need to hold your directors and officers to a higher scrutiny than that you would of your employees even. So whilst your employees coming in, companies may conduct security checks, look into their background checks, you should be careful to not miss this critical step in appointing your directors and officers. I think what's very important as well is the reputational damage that this could have on a company. In the event that any time down the line, issues come up that may have been missed, perhaps at the point where any of these directors or officers were appointed. We live in a very challenging period in South Africa at the moment where we see allegations of corruption as well as wrongdoing in both the private and the public sector. And we can't undermine the importance of doing adequate checks to directors and officers. I think a lot of the core decisions that relate to the interests of the company are taken by these individuals, and we need to put them under that heightened level of scrutiny.
Yeah, Mwenda, I'm just going to throw a question at you here, because I know certainly on the crime side of the portfolio, I mean, do you think we could have avoided some of the issues that we've seen if these things had been implemented, particularly the background checks and the lifestyle audits?
Simon, I definitely think the implementation of lifestyle audits would have raised the red flags sooner, that management would have been able to possibly manage and uncover the fraudulent individuals quicker. It just needs to pay greater emphasis on the risk management, just having them, but actually implementing them and possibly auditing the success of such implementations.
Yeah, I agree. I mean, I was interested to note, I mean, we've been talking in our team about whether or not we should offer these services, and brokers seem to be quite keen to see them on our risk management bouquet. But interestingly, when we chatted to the brokers, I'm just looking at the report here, it says 35% of brokers felt that their clients would actually commit to these things if they were offered. And a further 50% thought that they might, if they were motivated so by, you know, changes in deductible structures or premiums. So that's we'll probably be focusing on as we go into 2021. Can we move on to the next slide, please? Here's a trend that we saw throughout the report. Manisha mentioned it in her segment. There we were talking about risk registers. We talk about audit or risk committee meetings. 27% of the respondents said no ways, they're not comfortable doing that with their underwriters or even with their brokers. What do you think of that? What do you make of it, Tebogo?
I understand the confidentiality concerns regarding sharing these minutes as well as results of audits. But I think where it certainly does contribute to the underwriting process is for us to understand that risk management simply doesn't exist as a tick box exercise within the operation of the business. I think it presents an opportunity for us to see that the risk strategy, risk mapping is fully embedded in the daily operations of a company. We'd also see some level of collaboration between your board of directors as well as between your senior management. So it certainly does contribute to our better comfort with regards to the risk profile of any insured. I think as well as the fact that at claims adjusting period, having sight of these measures that are taken could support any defense in respect of the directors and officers where there's allegations that they perhaps have failed in their fiduciary duties.
Yeah, thank you. I think that you know, just looking at the other side of this infographic here, we asked the question about business rescue, and we asked the question because we think that this is on a lot of businesses' radars. They've just been through a particularly traumatic financial year in 2020. 23% of the respondents said they had no idea how or when to initiate business rescue. I don't have the number with me now, but I believe it was about 17% said they would actually wait until they were, you know, hit with with a request or an order from shareholders or creditors before they would apply for business rescue. Yeah, I mean, how important is it for directors to understand how this works?
I think it's critical, especially in the economic climate that we find ourselves in. The impact of COVID-19 will be far-reaching on the financial position of a lot of companies. What directors should certainly do is utilize the services of external consultants, especially in the event that they see that they're reaching a point where they may be approaching insolvency or they're unable to pay their creditors. Leaving the matter of business rescue or implementing some sort of turnaround strategy till too late, I think places undue exposure on directors and officers. So they certainly would be best put to be proactive in their stance regarding any challenging position that they might find themselves in. Business rescue is not, I think the incorrect impression that a lot of companies have is that this spells the end of a company, but it does not necessarily always end in litigation. We've seen that in a lot of instances. It actually allows the company time to regroup, re-strategize, and find some way with the support of the business rescue practitioner to continue their operations once they've gathered themselves together.
Shouldn't be as a delaying tactic to get out of an inevitable liquidation, basically. Thanks, Tebo. When are we going to move on to the cyber now? Can we just have a look at the next slide, please? Okay, so 37%, it's a big number. 37% of the businesses we spoke to in the survey said they'd had some kind of cyber incident, which could have been anything from ransomware to hacking, even to an accidental breach. And 28% of businesses commented that they'd had some kind of security issues during lockdown. Can we just chat about this, Mwenda? I mean, were you surprised at 37%?
Not at all, Simon. I think businesses have answered this question particularly well, taking into account that breaches aren't necessarily the external getting into the system, but a data breach internally. Perhaps an individual sends the email to an incorrect recipient. That too taken into what we call so that percent wasn't that surprising at all, Simon. Insofar as the 28% that have experienced cyber problems during lockdown, I mean, COVID-19 pandemic has changed the manner in the workplace operates. We found ourselves in an unprecedented situation where many organizations had to face the fact that they had to have a large number of their workforce, if not the complete workforce, working from home. I don't think necessarily that this was planned for and planned for it that well. In the sense that the systems be upgraded to take into the high number of people working off the work network. So that figure for me is surprising either, Simon.
Yeah, I think everybody was rushing around trying to keep their operations going. I heard of even some large corporates, you know, switching off their VPN so that people could just access via the internet. That was certainly in sort of March, April of this year, which of course just opened up their systems to all sorts of nefarious individuals. Can we move on to the next slide, please? Yeah, so 19%, that's of the 37%, said that they'd had some kind of ransomware extortion in the past 12 months. And the ransom was under 50,000 in each case on average. Mwenda, is this a corporate issue or is it an SME issue? What are your thoughts?
I think the fact that the ransom amounts were 50,000 and below could have been targeted more at the smaller entities. I do think the demands for the larger entities would have been much larger. The payment of a ransom, be it by the individual company or be it by insurers, does trigger an important question to address. And the question that we need to possibly ask ourselves is, paying these ransom, are we not encouraging some kind of criminal? Are we not in some way funding terror? Or are we not in some way adding to or contributing to anti-law events? At the end of the day, this is criminal activity. Important.
Yeah, thanks.
To the point is.
Thanks, Mwenda. I'm sorry, I'm not sure if it's just on my side, but the signal was kind of distorting a little bit. If I got what you were saying, you were saying that there might be some issues going forward with covering ransoms. Are we out of the reinsurance market that indicates this might dry up at some point, this type of cover?
Absolutely, Simon. We have seen some states in the East, to name Singapore, for example, where they have actually criminalized the payment of such ransom. So, I mean, an effort to what criminals could perceive as lucrative business, this pool might actually dry up in future.
Yeah, that is interesting. Can we move on to the next slide, please? Yeah, so 17% of the businesses that said they'd had some kind of cyber incident in the past 12 months said that it cost them more than 250,000, and 10% of the companies that had to take their systems offline said that they were actually offline for more than 72 hours, which I have to say, when I read it, 72 hours offline, if that had to happen on holiday with my kids, there'd be a mini protest in the TV room. But I mean, is that something that you think is we should be worrying about going forward? Data breach, business interruption, these are obviously key parts of the cover.
Yes, absolutely. So business interruption is a coverage point in the cyber insurance policy, but this is essentially business for any loss in profits which arise directly from the cyber event. What business needs to be aware of is that they need to have some kind of proper business interruption plan. They can manage it well. This is having to back them up regularly and check that these backups have actually generated. We find is the case, then the amount of time is reduced quite significantly. I think what we also need to just bear in mind is that the business interruption section does time excess, which does attract to it. And the time excess, the system would have had to be down for a specific hours before policy can respond. Excesses can range from anything from 12 hours right up to 48 hours. Now, if you are offline for that long, can you imagine the impact that would take on your profits?
Yeah, I was just thinking about some of these businesses over like Cyber Monday. In a digital kind of online retail environment, you could be looking at 30% of your profit for the year, just on that single day, or between Black Friday and Cyber Monday. So yeah, certainly business interruption means different things for different businesses. I think a hugely relevant part of the cover. Can we look at the next slide, please? This is the last part of the cyber discussion. I thought 18% was was a fairly meaningful number of businesses that already have insurance. I was a little concerned with the 23%. What do you make of this, Mwenda?
I think, yeah, 23% is learning. I thought, well, that business doesn't necessarily understand exactly what data is in terms of a cyber policy. I think they might be under the incorrect impression, because they don't necessarily hold of third-party data, cover necessarily for them. But we need to just unpack exactly what it is. It's not only third parties. All businesses employ staff. They would be capturing staff's ID numbers, they would be staff physical addresses, details for the purposes of payroll. And all of this within the ambit of data and a PII, personally identification. And hold of that, businesses at risk of being held liable by their own employees. So I do think that it is a conception, because they don't other data or larger amounts of data, that this isn't necessarily for them. Every business should inform of cyber.
Sure, thank you. Thank you to both. We've just kind of run out of time, so I wish we could continue this. Thank you, Tebogo. Thanks, Mwenda. I always appreciate your input, and yeah, I wish you all the best for the holidays, and I'll see you both back up in Joburg in 2021. So thank you.
Thanks, Simon.
Thank you very much, Simon.
To all the viewers, this is going to be this where I say goodbye to you. I just wanted to wrap up by saying I'd encourage you to download the report, read it. One of the things that we have noticed in all the various segments is that there does appear to be let's call it a trust deficit developing between insurers and clients, and there could be a variety of reasons for that. You know, not being prepared to share full risk information is only going to lead to problems at claims time. Whether you're talking liability, accident and health, cyber, DNO, it doesn't really matter. It's right across the board. And I think we have a collective responsibility to be transparent in how we underwrite, why we want specific information, and of course treat that with the utmost confidentiality, and encourage our clients to collaborate more with us. If we want to avoid these continuous exponential increases in rates and deductibles and reductions in capacity, we're definitely going to have to look at ways that we can incorporate more risk management and more risk participation on the part of clients. The insurance is just a part of the risk management process. It's not the only part. And I think the more time we spend talking about that as an industry with our clients, the more likely we are to have a sustainable business going forward through 2021 and certainly into the next 35 years. With that, it's also a pleasure to be presenting this to all of you. I've loved spending time with you. Thank you so much, SHA team, and to Chandra, Noni, and Alicia in particular for putting this together, and the CN and Co team. And yeah, back to you in the studio, Noni. Thank you so much.